One of the somewhat unfortunate consequences of being assessed to pay tax, becoming liable to pay tax, is that at some stage you have to actually pay that amount. So the periods that a self-assessment taxpayer, that's a company that does their own assessment, have to pay is actually longer than the rest of us usually have. For a standard self-assessment taxpayer with a financial year that ends on the 30th of June, you have until the 1st of December that year to pay. Whereas the rest of us who also have a year which ends on the 30th of June, but we have until the 31st of October in that year in order to lodge. And then if the Commissioner finds that or deems in the notice that we are going to have to pay, then it's 21 days from that point in time onwards. If you've got an extension from the Commissioner before that time, it's going to be 21 days from eventually when the Commissioner issues that notice of assessment. So what happens if you owe money to the Commissioner and you haven't paid? Well, the first thing to note is that this is a debt. So it's a simple debt which can be enforced through the court system ordinarily. Now, the ATO also have a wide range of additional powers that they can use to recover tax. But the key thing to note is that they're not obliged to go down that path. They can go through the court system as you or I can, as citizens, in order to recover a particular debt or an amount which is owing. So while the ATO do have the power to go through the court system ordinarily, usually that's not their first port of call. They, for policy reasons, try to start quite softly with individual taxpayers and liaise with them through telephone and email contact going backwards and forwards. As part of this process, the ATO can negotiate with you in terms of how you want to pay that with you, particularly if you have a large lump sum, whether it's more appropriate to pay that through installments. They can also accept security. In other words, you say that you're going to pay or secure finance in order to pay, but they can hold a charge over an asset or over other packets of money in order to really ensure that you are going to go through and do that, and those are forfeited if you don't. There are obviously the standard court proceedings they can take, which is to go through, issue a summons, have an enforcement hearing, and eventually get a standard garnishee order to usually deduct money from wages for individuals or from bank accounts for individuals and corporates. Finally, if that doesn't work, the ATO does have the power, again, ordinary powers, to put companies into liquidation or individuals, make them bankrupt. They have a series of other special statutory powers. They have the garnishee power, the statutory notice power. They can issue what's called departure prohibition orders, and they have access to a variety of the equitable remedies as well, so including Mariva orders, declarations of constructive trusts and such like. The Commissioner is given wide powers to give taxpayers the opportunity to defer their payments and give them extensions of time. Note that this is different from actually scrapping a particular amount which is liable. It is giving people the opportunity to spread payment over a long period of time. When doing so, they still have to follow the purpose of the underlying statutory framework itself. In other words, the purpose of taxation law is to protect the revenue, and so that the ATO can't arbitrarily choose to grant deferrals and extensions to wide classes of taxpayers. One place where the Commissioner can scrap an amount of tax which is owing is through the hardship provisions. Now, these can be done on a case-by-case basis where individual taxpayers, through generally no fault of their own, have nonetheless reached a point in their lives where they are going to suffer real, genuine, crushing hardship through having to pay tax. The Commissioner can go through and scrap that for individuals and for deceased estates. And note that in a situation where the Commissioner refuses to scrap some fraction of a taxation liability, that's a reviewable decision, and so that you can go through the ordinary objections process as part of that. Also note that while PAYG and income tax can be released, debts from GST can't. There's no statutory power for the Commissioner to go through and release that on hardship grounds. Parliament has also granted the Minister of Finance the ability to waive certain tax debts. This power is not used very often. Generally, it's in the rare situation where the tax office has refused to waive a particular debt for hardship reasons, and it's then gone to the minister, and that them for really social policy reasons have decided to waive that particular debt. Usually it's not done to score political points. It's they say it's really for more moral issues than that, in situations where the Commissioner herself or himself has deemed it beyond what they ought to choose to waive. So what happens if you pay your tax late? You've got to pay interest. The most common form of interest which is charged to a taxpayer who pays late is called the General Interest Charge, or GIC. The GIC is a high rate, and it's really designed to prevent people from deferring tax liability and obtaining some form of interest benefit. So it's really there to create a strong disincentive for people to pay their tax late, as basically to finance other activities. Note that the Commissioner can waive amounts that are owed in terms of interest. The AAT can also waive amounts that have been incurred as interest, but only to a statutory maximum, which is 20% of the total amount of tax which is payable in a particular year. Now, this process of calculating interest and adding it to the amount of tax which is payable is done on a compounding basis. So it's compounded daily, even though the amount is presented as an annual percentage. Sometimes when a taxpayer goes to the AAT or through the federal court, the amount which the ATO thinks they owed is actually reduced. As such, particularly where the taxpayer has already paid the amount because they're liable to pay, again, after the assessment is created, the amount of money then incurs interest. And that amount of interest is repaid to the taxpayer. So while that sounds like a positive thing, in practice at the moment, the base rate is outrageously low. It's very, very close to 0%. And so as such, there is a negligible amount of money which is repaid in situations where you are demanding the ATO repay you where you've been reassessed after winning an objection or appeal. A really important thing to note for those who do go into tax law as a discipline is the fact that the Commissioner, even when you are raising an objection, seeking a review through the AAT, and or then appealing that to the federal court, the Commissioner can still demand payment. So that you really need to note that this process of doing objection, review, appeal doesn't stay proceedings by default. You can ask the court to stay proceedings, and they do have power to go through and do that. However, they don't do it by default. Usually, the taxpayer is obliged to pay the amount which is in dispute before and during the process of lodging the objection, the review, and the appeal. It's a really important thing to note when you're advising clients. Federal court, when they're looking at granting a stay, take into account a variety of factors. The most important factor is the need to recover revenue. Ultimately, the entire purpose and existence of the ATO is to protect the revenue so that the mechanics of government can work. And if it were easy for a taxpayer to lodge an appeal and automatically get a stay, this would really undermine the whole process. And so the courts are going to look at this factor really more so than the others. So other things they will look at, though, to work out whether they're going to grant a stay is look at ultimately the merits of the case. Something that's likely to succeed versus something which is unlikely to succeed. In rare situations where the taxpayer claims there may be some abuse of office, the courts will look at that. But hardship, while a factor, is not a strong one when you're trying to get a stay of proceedings. So that's a key thing to note. Also note that if the particular arrangement or system that the taxpayer has set up, that they're going to seek review and or appeal from, is vexatious or contrived, or they've not disclosed all information to the Commissioner from the outset, the court's very, very unlikely to grant a stay while the action is going. There is another mechanism that taxpayers can use, which is the doctrine of estoppel. So a taxpayer still has all of the equitable rights and remedies available to them in the general law. And in kind of rare situations usually where the tax office has made some form of representation and the taxpayer has relied on that, and so much so that they're going to suffer detriment, and the ATO essentially reciling that promise is going to be unconscionable, then in that situation, then estoppel can arise. But in almost all other situations when you're dealing with statutory bodies, they're not stopped from performing the functions that are basically granted to them through statutory power. One really important mechanism that the tax office can use in order to seize money from a taxpayer, or in fact any person, in order to fulfill liabilities, is through what's called the statutory garnishee notices. This is a statutory power granted to the Commissioner in Division 260 of the Tax Administration Act 1953. So we talk about these garnishee notices, or sometimes refer to them as Division 60 notices, and note that this is a very powerful mechanism for the Commissioner to recover money, because it doesn't require the tax office to go to court. It merely requires them to serve the notice on the particular person. These Division 60 notices clearly can be used to obtain or recover tax-related debt, but note that they can also be used to recover judgment debts, so that rather than going through the ordinary system as you and I would in litigation, have an enforcement hearing, apply to the court to have wages garnished or money removed from bank accounts in order to repay debts. The Commissioner doesn't need to do that, even in situations where they've gone and got a judgment. Also note that any financial penalties will be essentially included and can be recovered using one of these statutory garnishee notices. And the amount doesn't have to be directed at the particular taxpayer. A Division 60 notice can actually be sent to persons who owe money to that particular taxpayer or who hold money on their behalf. So the common example here are the banks, the ADIs. Because Parliament has given the ATO this wide-reaching power to recover money, which could be misused in places, the courts, when interpreting these notices, construe them very, very, very carefully, so that the notice has to be crystal clear about who it is obtaining money from and who it's in relation to. It can't contain any errors on the face of it, and it must not require further explanation. In other words, the document or instrument itself must be sufficient for the person it's served to be able to fulfill it without any really interpretation or additional information required. Another thing to note about these statutory garnishing notices is that they can only be placed or requested of persons to pay in Australian currency. So there's no obligation to convert assets into Australian dollars or to convert foreign currency into Australian dollars. It's really important to note that these Division 60 notices have a high priority in regards to debts that are owed by the particular person who they've been issued to. So a person can't pay other entities or pay other debts in order to defeat a Division 60 notice. The Commissioner has the power to undo those transactions. Also note that where, for example, assets have been converted into a debt, that these Division 60 notices can actually place a charge across those debts themselves. And those debts can't be assigned to third parties. So that all three of these mechanisms make these Division 60 notices much stronger than the equivalent powers that you get in through going through the courts and obtaining a garnishee notice there. Now, also note though that this Division 60 notice attaches to taxation liabilities. So if a person might incur a taxation liability, the notice can't be given or can't be issued validly to that particular person for amounts that haven't yet become payable. So what would happen if one of your clients is issued a Division 260 notice to hold money or pay money to the Commissioner relating to another person, the actual taxpayer has the liability? Well, if you do pay that money to the Commissioner, you cannot be sued by the particular taxpayer for not paying that amount to them. There's statutory immunity, which is granted to you. However, on the flip side, if you are asked to pay some money under a Division 260 notice and you don't, then there is a penalty of 20 penalty units. And as well as that, you can also be ordered to pay that amount as well to the Commissioner. Now, in continuing with our theme of outrageously strong remedies that the ATO have in regards to people not paying the tax, there is a particular remedy called a departure prohibition order. This is basically a statutory instrument or notice which is given under legislation preventing a person from leaving Australia until they've made arrangements to pay a particular amount of tax which is owing. So the ATO has statutory power to stop you from leaving Australia even if you are not an Australian citizen. Once issued by the tax office, the DPOs actually stay in effect forever, or at least until you've paid the amount of tax which is owing. You can ask the court to set them aside, and the Commissioner has discretion to revoke them as well. But ultimately, there is no sort of statute of limitations or time period by which a DPO is going to time out where you owe money. A couple of other key things to note about departure prohibition orders. Firstly, there is no requirement for natural justice or procedural fairness. The Commissioner can issue these things, is not required to let you adduce evidence as part of this process, and is not required to issue a statement of reasons. They can, if you have a particular liability, they can issue a DPO. Once issued, they can give information to the Department of Immigration, preventing you from getting on a ship or a plane, and otherwise take all other reasonable steps necessary to enforce a particular DPO, including actually physically removing you from a plane or a ship that you happen to be on. If you do wish to leave Australia while a DPO is in effect, you can apply for a departure authorization certificate to be allowed out of Australia for a period of time. When the taxpayer who owes money and is under a DPO applies for a departure authorization certificate, the commissioner's got to be satisfied of some things before they'll actually issue it. Now, the first one, or the primary one, is whether or not the particular person has given security. So if there are, for example, assets remaining in Australia that could be used as security for the particular liabilities, that's not going to be problematic. In situations, though, where it's not desirable to do that or not possible, the commissioner's got to be satisfied the person is going to return and that they are going to, or be likely to, discharge these liabilities upon their return. There are some other situations where, for the best interests of Australia or on humanitarian grounds, a departure authorization certificate is granted, but they are actually very, very rarely used. One thing to note about the tax office and I guess the commissioner is that they're an ordinary litigant. In other words, they, when they're owed money by any particular taxpayer, can use the inherent powers of the court as an ordinary litigant in order to obtain a particular result. One of the things that we all get is the option of going to court and getting what we call an asset freezing order or a Mariva injunction. This is an equitable remedy that is really granted to prevent assets from being dispersed or otherwise disposed of in order to defeat a future court judgment. Note that because this is an injunction issued under the inherent power of the court, that where a person just willfully ignores an injunction and goes off, in this case, and disposes of assets, that's punishable as contempt. It's an inherent power of the court to go through and resolve that particular breach in this way. To obtain a Mariva injunction, again, the ATO as ordinary litigant must demonstrate the 5 elements of this particular cause of action. They have to demonstrate that they've got a prima facie case. They have to make full disclosure. They have to prove the assets are actually there, that there's a real risk to those assets, and they have to make an undertaking as to costs as part of that. So it's basically the same principles that an ordinary litigant would have in order to obtain this particular form of remedy. I'm going to turn now to some issues of tax compliance. And the first thing I'm just going to talk briefly about is AUSTRAC. Now, AUSTRAC is an intelligence service that is responsible for looking into fraud and terrorism-related activities and money laundering and such like. One thing to note is the ATO as a statutory body is obliged to report any suspicious transactions and any transaction of more than $10,000. They are obliged to report those transactions to AUSTRAC. That information is then used and as part of the analysis by the intelligence agencies in order to be cross-checked with the other bodies that that go through and enforce these particular parts of the law. Now we're going to move on to a really super exciting part of tax law, TFNs. I'm joking, it's really not that exciting at all. So basically the TFN is a registration number. They're unique for each taxpayer. And while originally they were set up to try and facilitate transactions between the ATO and taxpayers, in practice over time they've really moved to be used as an important mechanism for data matching and for, again, the various analysis bodies inside the ATO and other anti-fraud bodies in the federal government for anti-evasion and fraud detection and the financing of terrorism and other such things. So the TFNs, not particularly exciting, not particularly interesting, but we do have to look at them with a little bit of depth. So strictly speaking, you don't need to have a TFN. However, in practice, when you are undertaking a variety of transactions or obtaining some sort of benefit, you're going to suffer some detriment if you don't supply a TFN. Some examples here are receiving dividends, receiving PAYG payments, so wages or salaries, being in a superannuation fund, obtaining the first home owner's grant, getting a student loan, or receiving other form of benefits from the federal government. If you don't supply a TFN, you either won't be able to obtain that benefit at all, or a larger amount of tax will be withheld as part of this transaction. Moving on to ABNs. An ABN is an Australian business number, which is a unique 11-digit number that's issued by the Australian Business Register. Now, this is ultimately actually managed, or the chief executive is the Commissioner of Taxation as well. So the ABR and the ATO are quite closely connected. And the key thing to note is that business-to-business transactions must withhold tax unless a valid ABN is quoted by the other side. So if you are making a payment in the course of an enterprise to another enterprise, if they do not supply a valid ABN, you must withhold an amount of tax and remit that to the Commissioner. I will note that there are quite a lot of exceptions to the requirement to quote an ABN to prevent tax from being withheld. I put these on the slide. It's quite long, and so I'll just highlight a couple of the key ones. First one, which really is ultimately just a restatement of the fundamental purpose or reason of ABNs, is that if a payment is made that isn't furtherance of an enterprise, then you don't have to worry about ABNs. So that can be private or domestic transactions or hobbies. Now, if you're not sure, you can actually get the other side to put this in notice, in a written statement. That's the fifth item in this list here. Payments for $75 or less, don't need to withhold tax. Payments to minors, payments to body corporates where you are a member of that building scheme, payments of insurance and financial transactions, which we say is wholly input taxable under the GST system. Payments of things like rates, they don't form part of the ABN system, and as such you don't need to withhold money and remit it to the Commissioner in those situations. We're going to look now at the PAYG, or pay-as-you-go system. A couple of things you need to note about PAYG is that it uses a common set of rules and framework to achieve two particular types of object. First one is to stop bill shock. That, particularly for ordinary taxpayers, is going to be extremely problematic. So again, we could sort of imagine that if we were, as employees, given the full amount of money that we're owed by our employer, by the time it reaches our tax return, a non-zero fraction of people will have no money, spent it all, and it's gone. And then they're going to owe large sums of money to the Commissioner. That really just doesn't work as a system. So this idea of this first part is this withholding system is really the first aspect of PAYG. The second aspect of PAYG is in order to have taxpayers who would otherwise pay a large amount at the end of the year, we want to prevent them from having leakage. In other words, from either not paying, companies going into liquidation, for example. And so as such, we want to have a system where they will pay amounts in installments throughout the tax year rather than one big lump sum at the end. And so you do need to note that while these two systems do use a common baseline framework, they're actually fundamentally different, because the PAYG withholding from employers, for example, is telling the employer they must remit money to that would otherwise be paid to an employee to the ATO. Whereas the installment system is set up for payers, particularly full self-assessment taxpayers, for them to do it themselves and to do it periodically in order to spread their liability out over the tax year. One common thing to note, though, is that at the end of each year, you look at the amounts that have been paid or withheld either by the employer or by the company taxpayer paying installments. You look at the amounts that are actually being paid, and you got to compare that with the amount which is assessed for that particular tax year. And if you have withheld more money and that's been remitted to the commissioner, you will get a refund. And so individual taxpayers in and around tax time, in Australia, it's not uncommon for people to obtain tax refunds during tax season. That's because more money's been withheld than is actually been assessed for that particular year. So when we look at PAYG as a withholding system, this idea of usually employers withholding money and remitting that to the ATO is really the primary purpose of this particular aspect of the system. Note that in situations where a person is being paid in something other than cash, the person doing the paying is still required to pay some fraction of money in Australian dollars to the commissioner as part of that. So this PAYG as withholding system, while it's primarily used for employees, for employers to remit money to the ATO and save employees a lot of hassle, there are a variety of other circumstances where PAYG withholding is made. Now, many of the situations and scenarios where PAYG withholding is made have been explored elsewhere in this subject. So, for example, payments to foreign residents or to people that you believe or ought to believe are foreign residents. The amounts have to be withheld in that situation. Similarly, when paying dividends, so unfranked dividends, distributions, paying interest payments, royalties, amounts have to be withheld from those. There are a variety of other places too, certain types of superannuation payments, retirement payments, leave and such like. In those situations, PAYG has to be withheld, and the rates, however, vary for different types of payments. One important thing to note for students of tax law is this idea of needing to withhold as part of the alienated personal services regime. It goes something like this. If you were to trot along to ASIC and set up a company, and then you were to go and issue invoices for work that you yourself do in the name of your closely held company, in theory, when that money comes into that company, it's going to be taxed at the corporate rate, which presently is shy below 30%. Now, it would be relatively simple for you to do this, and particularly in situations where you otherwise are earning at the top marginal tax rate, to obtain a tax benefit. So the alienated personal services regime is set up as an anti-avoidance mechanism to basically be a pass-through, whereby entities who are receiving income, which is personal services income, which is defined as income mainly as a reward for personal efforts or use of skills. If you're receiving that type of income, you are required to remit an amount of money to the commissioner through the PAYG withholding system. So it's a key thing to note that you aren't going to get around or get out and avoid paying tax at the top marginal rate through using a company, a partnership, or a trust, where you closely hold those particular entities and you are functionally undertaking those particular services and deriving personal service income. So, how much needs to be withheld? Well, ultimately it depends. The key things to note about the amount of withholding that you must do as a payer is that this is actually governed by regulation. So the ATO will each year publish the amounts that are to be withheld from certain types of payments. When they're doing this analysis and making this publication, they need to take into account a variety of additional factors. So, for example, the Medicare levies, any form of HEX repayments, family tax benefits, and offsets for things like low-income earners. And these amounts are published. They're not crafted through legislation. They're created through delegated instruments and established by the ATO themselves. When we look at PAYG as an installment system, we really need to start by noting that this is really for companies. Fully self-assessed taxpayers are the ones who need to pay tax in installments. Why? Because Parliament tells them they have to. Otherwise, entities will defer till the end of any particular year and really obtain a financial benefit from doing so. So there is a cost in terms of money and financing as part of this. There's also risk to the Commissioner because ultimately, if conditions go sour for a business entity, then the Commissioner is less likely to receive the full amount at the end of a particular tax year. So the size of the entity will dictate how often these payments have to be made. Large entities have to do them monthly, smaller entities quarterly. Some do them annually as well. So the idea being that you look at your previous amounts in quarters or months or years. That is used as a basis to determine what your next year's amount of installment payments are going to be. And much like PAYG withholding, at the end of the year, essentially these amounts are balanced out. So the amount that you're assessed in terms of tax may be more or it may be less than the amount you've already paid as part of the installment system. So what happens if a business pays their installment late or not at all? Well, it's a debt like any other. It's a taxation-related liability, and interest will apply to those amounts. So the GIC, the general interest charge, the higher rate, is going to apply on a daily compounding basis from the point in time that an installment becomes due. Turning now to the taxation penalties and offences. Now, it's really important to note that the overarching principle of all tax offences and the reason why the tax office prosecutes people is not primarily to protect the revenue by getting back the money from that particular taxpayer. It is to deter others from miscompliance. In a self-assessment system, we want people to do the right thing, to correctly calculate their tax, pay their tax, and not require any intervention from the government at all. So the system that the tax office has open to them in terms of penalties really falls into two categories. You have the administrative penalty system, the UAP, and we've got the criminal system as well that requires either the ATO or the Commonwealth Department of Public Prosecutions to go to court. A couple of things to note about the penalty system. First of all, the administrative system is set up to create deterrence through interest. So the idea is that people have an incentive to pay tax because otherwise they're going to be penalised with needing to pay more tax. So the general interest charge, which is the higher rate, is designed to encourage people to get it right the first time, whereas the shortfall interest charge, which is a lower rate, is designed to still charge people where, for whatever reason, usually not their fault, their tax needs to be reassessed. There's no culpability that's really brought into that. Nonetheless, it wouldn't be fair for some taxpayers to obtain some financial benefit in terms of having money for a longer period of time. Another thing to note is that the ATO actually themselves brings about almost all of these penalties. They do all the administrative penalty things, and they do most of the prosecutions as well. It's only the more serious offences, the more complex matters, particularly with larger entities, that the CDPP get involved. When looking at the GIC, the general interest charge, you'll note that it's quite a high rate. It's 7%. The 7% is actually added to the base interest rate, which at the moment is very, very close to zero. But in previous times, the base interest rate could be up into sort of between 2 and 5%. Note that ultimately the GIC is used to really deter people from using the deference of tax liability as a mechanism of finance. So it is a strategically unwise idea to try and defer paying your tax, because 7% is quite a lot. That's ultimately where the GIC sits in the system. Whereas later we'll look at penalties. They're not really set up the same way. GIC isn't so much a penalty for wrongdoing, so to speak. It's really to do with trying to deter people by having a high rate set up to really stop them from ignoring or deferring their tax liability. Situations where the Commissioner increases a taxpayer's liability and they haven't really had any fault component as part of this. An amount owing, nonetheless, is still going to incur interest. This is the shortfall interest charge. This is when an assessment is increased. This amount is only 3%, and it's really set at the lower rate because ultimately it only applies in situations where a taxpayer is unaware that they would have to pay an additional amount of money, and therefore subsequently they weren't able to take steps in order to reduce that amount. When we look at penalties, these fall into broad categories. Again, you've got the civil penalties that fall under the UAP, and you've got criminal offences, which we'll deal with a bit later. So there are three categories of these administrative penalties. The first is for tax shortfalls, for creating a tax shortfall. The second is failure to lodge on time. And the third falls under what we just call the miscellaneous civil penalties for a variety of other things that pop up. One of the more interesting, well, I think it's interesting, aspects of taxation law is the idea of culpability being very finely granulated. So unlike other areas of law where you will have particular compensation systems in tort, or you'll have certain crimes where you've got quite clear delineations between intent, recklessness, negligence, and so on. In tax, there are more potential ways that a person can be held liable, and as a result the system for allocating these penalties is very granular. Unfortunately, it also means it's quite complex. So there are 6 steps that you have to follow in order to determine how to apply these shortfall penalties under the administrative penalty system. So the first thing is work out whether or not an administrative penalty applies. Then you've got to look at whether some form of exemption or defense is going to apply, some excuse or possibly some way to have things struck out. You also have to look then at what we call the base penalty that they have, which will usually depend on the type of provision or type of wrongdoing the taxpayer has done. Then there are certain statutory rules for increasing a particular penalty because of aggravating circumstances. There are also factors for decreasing, for certain mitigating factors. And then finally you have to look at the discretionary power of the Commissioner to remit part or all of a penalty. There are 4 different types of administrative penalty provisions. If one of them applies to the taxpayer, that's going to tick that box. If a particular situation has multiple areas, it's the one with the largest penalty. So the 4 different types of administrative penalties are where a person makes a false or misleading statement, where they take a position which is not reasonably arguable, whether they fail to provide a document when they're required to, or when they have a scheme which creates some sort of shortfall. We'll look at these in turn. So the first of these administrative penalty categories is false or misleading statements. A couple of things to know. First of all, it's whether a particular statement that's been made either by the taxpayer or their agent. So it doesn't matter who makes it. Your agent, tax agent, can make a statement. If it is false, it does not matter about your intention. So your actual level of honesty or subjective belief in the truth is actually not relevant in regards to false statements. However, it is relevant for the purpose of misleading statements. Now, a misleading statement can be literally true, but where it is intended to create a false impression or belief, that is where it will be misleading. So they're 2 sides of the same coin. Something is absolutely false, regardless of intention or belief or honesty. Whereas misleading is where the thing sometimes can be false, but usually is actually literally true, but intended to create a false impression. That is considered to be misleading for the purposes of administrative penalties. It's a full excuse, an exculpatory statutory provision to an administrative penalty for a false and or misleading statement if either you and your agent can demonstrate that you took reasonable care, or if the particular taxpayer uses a tax agent or a base agent and the safe harbour rule applies. We'll look at both of these excuses in turn. There's a couple of things you need to know about the excuse that gets you out of a false or misleading statement for the purposes of the administrative penalties. So a couple of things. Firstly, that it applies to both the tax agent and the taxpayer. So they both have to take reasonable care. Secondly, the level of reasonable care that they have to take is different. Usually, tax agents have greater level of tax knowledge, expertise, skill, and experience, so their standard of care is higher. Thirdly, that the test itself is both subjective and objective, because you look at the actual experience, age, health, skill of the particular person, either the agent or the taxpayer, and then look at the level of care that a reasonably prudent person with that knowledge, skill, experience would have. That's the level of care that ultimately the court will examine if these things get that far. The other thing to note is that you can have situations where a particular mistake that's been made by the tax agent will get a penalty because they have the higher standard of care, whereas the same mistake made by the taxpayer would be excused. So in order to actually use this excuse, though, both agent and taxpayer must meet that threshold. Another way to escape from an administrative penalty for a false or misleading statement is through use of the safe harbour excuse. This only applies to registered tax agents and base agents. And simply it's where the agent makes the statement and the statement, either the falseness of it or the misleading nature of it, was not due to recklessness or intentional disregard of a taxation law. So if both of those things apply, then the administrative penalty for a false or misleading statement will not apply. The next type of administrative penalty falls under the heading known as not having a reasonably arguable position in relation to a taxation law. This is actually quite an interesting area of law because it is unique to tax law. Because tax is a complex discipline, there are lots of rules. Sometimes those rules appear to be in conflict with each other. And taxpayers can and do read the law and adjust their position accordingly. Now, if a particular taxpayer does treat a particular tax law in such a way so as to be not reasonably arguable, and it causes a shortfall amount of more than either $10,000 or 1% of the income tax which is payable, then a person doing so is going to be liable for an administrative penalty. So what does it mean to have not a reasonably arguable position? Well, the test for having a reasonably arguable position is an objective one, which if it were to go before the federal court, the test is stated that it would be having regard to all of the relevant authorities, it would be concluded that the taxpayer's argument is either more likely to be correct than incorrect, or about as likely to be correct as incorrect. In other words, you're either probably right, or you might be a little bit wrong, or you might be a little bit right, but it's about the same. And note that this, importantly, is a question of law. This is about the law itself, not about facts. So the not having a reasonably arguable position only relates to the taxpayer having an error in terms of how they have applied the law. It does not at all depend on facts, and it doesn't depend on any particular knowledge or intention of the taxpayer. It's purely an objective test looking at the relevant laws. Third category of administrative penalties is failure to provide a document. This one's pretty straightforward. If you don't provide a particular document by the required date and the commissioner makes a determination of tax liability without that document, you are liable for an administrative penalty. Note that there doesn't need to be a shortfall in regards to this, and there is an additional penalty which is expressed in penal units for failing to lodge a document on time, which we'll come to in turn. If one of the general anti-avoidance provisions somewhere in the tax law applies, and as a result you pay less tax than you were supposed to have, as well as bringing an action under those provisions, the system that it sets up in terms of you paying less tax is what's known as a scheme shortfall. And so that falls part of the administrative penalty regime itself. If we determine that one of the administrative penalties is going to apply, we can then have a look at exemption. So there are general excuses that can apply to any of the penalties. One of them is what we call the ATO advice exemption. That's where a particular taxpayer has relied on advice which has come from the tax office themselves. So that can be through a private ruling or through correspondence or statements in public rulings in what they call general administrative practice of the tax office, where they habitually or customarily respond to taxpayers in a certain way and have done so over a long time, or where a direct statement has been made by the commissioner in a particular publication. So if you have relied on ATO advice from one of those areas and you can demonstrate that, you will not be held liable for an administrative penalty. Another area where you can get an exemption, although strictly speaking not by right, through discretion of the tax office, is through their one chance policy. This is a policy, it's not a rule, but the ATO for a few years have basically said, look, where you haven't got recklessness or dishonesty or a history of non-compliance, you can get off an administrative penalty once. So it doesn't apply to wealthy individuals. It doesn't apply to large corporate entities, but small businesses and individuals who aren't wealthy can ask the ATO for this one chance exception to remove administrative penalties. Now, if we've determined that one of the administrative penalties is going to apply and there's no excuses to get out of it, we then have to look at the base penalty amount. The base penalty amount is going to depend on really how culpable the particular taxpayer is or their agent has been. And so the first two, the failure to take reasonable care or taking a position that was not reasonably arguable, start with a penalty of 25% on the shortfall amount. Now let's be clear, if you have a shortfall because you've done one of those things, you're going to have to pay that shortfall back. That is just a given. You owe that money. Here we're trying to determine how much extra you're going to have to pay. So if it's more than failing to take reasonable care or a not reasonably arguable position, if it's more than that, if it's reckless conduct, it's going to be 50% of the tax shortfall. And if there is no tax shortfall, the penalty is 40 penalty units. That's for reckless conduct by a taxpayer or their agent. If there is intentional disregard, you look at the shortfall amount and you have to pay a penalty of 75% of that amount. Or if there is no tax shortfall, it's going to be 60 penalty units. When we're looking at these base penalty tests, the two key adjectives here is recklessness and intentional disregard. So intentional disregard is a subjective test. Basically, the taxpayer or their agent has to know what the law is. They have to know how it applies in these circumstances, and then they have to just deliberately do otherwise. It's pretty hard to prove, but like other areas of law, intention is hard to prove. Recklessness, however, is an objective test. So it's got to be more than negligence or carelessness or inadvertence. It has to be that the person has demonstrated either complete disregard or indifference to whether or not a particular representation that's been made is true and correct. In other words, they just put their head in the sand and just don't care in regards to a particular statement that's been made. In situations where the particular taxpayer has either actively taken steps from letting the commissioner discover tax shortfalls or has become aware of the shortfall as a result of some false or misleading statements that have been made, then subsequently hasn't told the commissioner, or if they've intentionally flouted tax laws in the past and haven't taken reasonable care, then in any of those three situations, the basic penalty amount is going to be increased. So it's increased by 20%. So it's the penalty amount that increases. So an increase of 20% is in a situation where the base is 25% of the shortfall amount is going to change the penalty amount to 30%. So it's not adding 20% of the shortfall amount, it's adding 20% of the penalty amount. There is an important mitigating circumstance, and that is full disclosure. So if a taxpayer makes a voluntary disclosure of a tax shortfall, their penalty amount will be reduced. Now, again, keeping with this theme that we've seen throughout this subject, where you've got a self-assessment system and we want people of their own volition to own up to their mistakes and try and fix them. If you make it before the particular taxpayer has to go and do an audit or has been informed that they're about to be audited, then the amount's going to be reduced by 80%. if it's more than $1,000 or 100% otherwise. If, however, this disclosure is only made after the ATO has informed a taxpayer that they're about to be audited, you'll still get a reduction, but that base penalty is reduced by 20%. Once we've determined that there is a penalty and determined what the base amount is, looked at the mitigating factors, looked at the aggravating factors, checked to see whether there's any excuses, really the very last thing to go through and try is to ask the ATO to remit the penalties. And they will do so if it's fair and reasonable to do so. And they're going to look particular at the circumstances and primarily whether or not the particular shortfall has been caused by the taxpayer. That's really the dominant factor. They'll also look at the conduct of the taxpayer after the error has been found. So the timeliness, in other words, how long it's been since after the error that the taxpayer has disclosed. They're going to look at the amount of the shortfall, and they're going to look at whether or not the particular taxpayer has a strong record of compliance or doesn't. The second type of administrative penalty, and again it's a pretty simple one, is failing to lodge. It's an offence of absolute liability. If you don't make your lodgement on the due date, you're going to get penalised, and the amount is 1 penalty unit for each period of 28 days to a maximum of 5. Note that that's multiplied for medium-sized withholders, doubled for medium-sized, and quintupled for large PAYG withholders. And note that there's no excuse for this. It's simply a penalty, and the shortfall amount isn't relevant as part of that. This is going to be the penalty that you're going to have. Once you have suffered or incurred an administrative penalty, the Commissioner will produce a notice of assessment. So it is just an assessment like any other. So it will come in the appropriate form, say that this is an assessment, and you will become liable for that amount which is in that particular assessment, as if it were any other tax-related liability. And note that this penalty assessment is itself subject to the objections process. So you can raise an objection, then seek review in the AAT, then appeal to the federal court as part of this consistent and common theme of tax rules. I'm going to turn now to the offence provisions, and the overarching principle behind the ATO bringing about prosecutions against taxpayers is deterrence. We want to have a system where people do the right thing. As such, we must demonstrate as part of the system that people who do the wrong thing are going to suffer. They're not going to benefit through non-compliance. So this is the overarching principle behind prosecution in tax law. Offences form two different and distinct types in tax law. The first category we'll look at here are known as absolute liability offences. These have no physical fault element as part of them. So there's no aspect of fault, and you can't use mistake of fact either. So merely being mistaken about a date, a time, what the Commissioner asked for, doesn't matter. Ultimately, you're going to be liable if, under a tax law, you're required to do one of those things. Furnish an approved form, give information to the Commissioner, lodge, cause an instrument to be stamped, notify the Commissioner, produce documents, attend, or apply for GST, registration or cancellation. If a law says that one of those things applies to you and you refuse or fail to do that, you are liable to an offence, and the fault is not relevant as part of that. The strict liability offences arise when a person attends the Commissioner. In other words, the ATO asks a person to attend. When they attend, they either don't answer a question that's put before them, or don't produce a document, record, paper of some sort. These are strict liability offences, which means that ultimately there's no fault element. But if you have an honestly held and reasonable belief about the particular document or question, that means that you refuse or fail to answer, you will have an excuse. There are also some other excuses that will apply to all of the offence provisions. The first is the capability excuse. You're only going to be liable for a strict or absolute liability tax offence if you're actually capable of complying with it. And so you actually can get out of a tax offence through ill health, infirmity, age, or a lack of mental capacity. Now, while they do interpret these things quite widely, courts actually have a pretty dim view in terms of whether a person is capable or not. So it's actually quite hard to raise this particular excuse. You have to demonstrate an overwhelming inability or lack of capacity in order to really get off from a particular offence in regards to taxation law. Another excuse that we have mentioned at other places in this subject is legal professional privilege, so that documents that are obtained that LPP applies to can be claimed, and those documents can't be used as evidence in regards to these offences. Also note, though, that the evidential rule for what we call a privilege against self-incrimination, that doesn't apply. A person is required to go through and to do things, produce documents, answer questions, and they have a positive duty to do so. As such, you can't rely on the general law privilege against self-incrimination. The penalties for the administrative offences depend very much on how many times a particular offence has come up. So it's 20 penalty units for the first, 40 for the second, and 50 and/or up to 12 months imprisonment for a third or subsequent offence within a 5-year period. If a person makes a false or misleading statement to a taxation officer, that is an offence. Now, this is different and distinct from the administrative penalties that one gets through creating shortfalls through false or misleading statements. The two can operate separately. However, in a situation where a false or misleading statement is made to an officer and there's no shortfall amount, nonetheless, you can still suffer penalties. So note that there is an excuse to a false or misleading offence. You have to prove that you didn't know that that particular statement was false or misleading, and you could not reasonably have been expected to know. So this is both a subjective test, you have to demonstrate that you actually didn't know, and a reasonable person wouldn't have been expected to know that particular statement was false or misleading. The definition of misleading, the definition of false is still the same as the administrative penalties. And note there, it's 20 penalty units for first offence and 40 for second or subsequent, but that's aggravated if it's reckless to be 30 for the first and 50 for the second or subsequent. And if intentional, it's 50 for the penalty units for the first offence and 100 penalty units for the second, with 12 or 24 months imprisonment as the maximum there as well. And if this leads to a person being convicted and there is an amount of tax which has been avoided as part of this process, the court can order them to pay twice that amount as an additional penalty. Keeping incorrect records is also an offence under taxation law. And the structures of this are quite similar to the making false or misleading statements to a taxation officer. But if you fail to keep records that are accurate, or you basically fail to correctly show or demonstrate what a particular position that the taxpayer is in, that is going to be an offence. Again, there is an excuse if you didn't know the relevant accounts were incorrect, which is the subjective test, so you didn't know, and you could not reasonably have been expected to know the objective test. You have to prove both in order to use that excuse. The penalties are the same, 20 for the first, 40 for second and subsequent ones within 10 years. And they are aggravated by recklessness and intent. Note, though, that the penalty is 3 times the amount. So if incorrect record keeping leads to an amount of tax being avoided, the penalty is going to be 3 times the amount of that tax as an additional penalty that the court may order. Finally, in regards to taxation offences, note that all of the other aspects of the criminal law still apply. And so, for example, a taxpayer that obstructs, prevents, perverts, or tries to defeat the course of justice commits an offence. Similarly, if a taxpayer attains property through deception, or obtains a gain from a Commonwealth entity, or obtains a financial advantage through fraud, then all of the relevant crimes in the Federal Crimes Act and Criminal Code are going to apply. It's still fraud. Also note that a taxpayer who commits an offence will also fall under the Proceeds of Crimes Act. So if you do commit a taxation-related offence or any of these open-ended general fraudulent offences, then you can have assets forfeited as part of the penalty in the process that the Crown can bring an action after you have been convicted. I'm going to turn now to the regulation of tax practitioners. Now, tax practitioners, for our purposes, just generally I refer to them as tax agents. However, they come in 3 different types or flavours. You can be a registered tax agent, you can be a registered base agent, and you can be a tax, and in brackets, financial advisor, or TFA. Now, a couple of things to note about all 3 types of tax agent, which is important for the purposes of tax law. The first thing is that only registered tax agents can charge for preparing income tax returns or doing tax-related works. You have to be a registered tax agent to do tax work. That's the first thing to note. Secondly, that where you have a registered tax agent, if you incur expenses in terms of paying them to do your tax returns, that's actually tax deductible. It's not tax deductible if you get your friend to help you or similar. And also note that if you go to a tax agent, their lodgement rules mean that they, to avoid having to lodge all the tax returns, particularly for individuals, between July and the end of October, they can do their lodgements throughout the tax year. So you can spread things out over the course of the year. All 3 of those features make it quite desirable to use a tax agent as part of lodging and completing your tax returns. So we're going to look at how you can become a tax agent, base agent, or TFA. So the key things to note, and look, this should look pretty similar to those who are doing accounting in terms of the CA and CPA requirements, or law in terms of the LPAB requirements. So starting off, you've got to be over 18, you've got to be a fit and proper person, and you've got to meet the education and experience requirements prescribed in regulations. Note that there are some transitional experience requirements for people who are already on the various tax agent sort of advisory boards and in those professional bodies. I've excluded those from these particular rules. So you will see when you go, and if you want to go and read the regulations, an additional category for people who are already a voting member. We're going to assume for the purposes of this subject that you're not already voting members on these particular bodies. So to become a registered tax agent, there are a couple of different options. basically, if you have done an undergraduate degree with relevant subjects and relevant qualifications, you don't need as much full-time work experience as part of it. So that, for example, if you hold a Bachelor of Business or a Bachelor of Commerce, you've got an accounting major, you only need 12 months of full-time experience within a 5-year period in order to become a registered tax agent. If, however, you did a BBuzz or a BCom in a non-accounting major, you've got to also do a variety of subjects. So look, perhaps this is unfortunate, particularly for people who are watching this video in their very final teaching period of university, but these are the requirements that you are going to need if you haven't got those qualifications and you want to go and be a registered tax agent. You'll have to do those things subsequent. Note that a law degree, an LLB, you would have to do, in addition to an LLB, you'd have to do accounting and tax law. If you have a non-accounting major, you'll have to do an accounting course and a commercial law course, as well as a taxation law course. With diplomas, only an accounting diploma is going to count, and then you've got to do 2 years of work experience. If you haven't got any diploma or degree, you can still become a registered tax agent, but you still have to do a course in accounting, you've still got to do a course in tax law, and you've got to have worked for 8 years. To be a registered base agent is much less onerous than a registered tax agent or a TFA. To be a base agent, you've got to have a Cert 4 in either bookkeeping or accounting. You have to have done a course in GST and base principles, but you do need quite a lot of hours as part of that. So it's 1,400 hours of relevant work experience in the 4 years preceding your application. To become a tax, in brackets, financial advisor, TFA, you have to, this applies to all of the categories, you actually have to work for or hold a financial services license. You either have to work for a licensee, so a person who holds a financial services license, or either hold one yourself or work for one. And you've got to do one of these sort of 3 things. You've either got to have completed a degree in business or law with an accounting, finance, economics or law major. You've got to have done commercial law, you've got to have done tax law, and you've got to have 12 months of experience. If you've done a diploma in law, economics or accounting, you also need to have done com law and tax law, but you need 18 months of full-time experience. And if you've done neither tertiary qualification, you still need to do those 2 courses, com law and tax law, but you've got to have worked for 3 of the last 5 years in basically in these particular roles. For students familiar with the accounting CA and CPA requirements and the law LPAB requirements, you'll be aware that there is a requirement for continuous professional learning. We call it CPE in the tax regulations, continuous professional education. There is also a requirement that you are insured. So when you are giving advice as a registered tax agent, a base agent or a TFA, you must hold professional indemnity insurance as part of that. So you've got to do continuous education each year and hold insurance in order to maintain your registration. Now, the penalties for being an unregistered tax agent are massive. I personally was quite surprised when I had a look at these. If you are a corporation providing tax agent, base agents or TFA services while not registered, it's 1,250 penalty units. That's a staggeringly large sum of money. So it's probably important to leave on the back of your mind if you are doing giving tax advice or advertising yourself as being a tax agent, or representing to others that you are a registered tax agent, base agent or TFA, that you be aware of this, because these penalties are massive. Again, the slides there with the individual amounts, but please, when you are going into the world and taking your newfound tax knowledge, be very wary about making representations that makes it look like you are a registered agent when you're going through and dealing with third parties, because the penalties they have for doing so are huge. Most professions have a code of conduct, some set of ethical rules that they use for being consistent in terms of how members of that profession act, particularly in regards to consumers. Tax practitioners are no exception. So they have a code of professional conduct, which is in the TSA, and it says that they have certain obligations which are enforceable under the statute for honesty, integrity, independence, competence. Also a couple that may be a little less intuitive: non-obstruction of taxation law, the administration thereof, and full disclosure to clients of their rights and obligations under taxation laws. These are just a subset of all of the ethical requirements of a tax practitioner. And note that they are similar but not identical to the equivalents for CA, CPA and for legal practitioners. Finally, tax professionals who give advice can be held liable for poor advice. So in the general law, there's an implied term in any contract for professional services that the particular person giving those services are going to act reasonably and be reasonably competent in a particular professed field of expertise. That's just implied in the general law. Also note that negligence is going to apply. Now, that is going to come up usually in two situations. Because it's so much easier to sue in contract than it is in tort, usually negligence will apply either where there isn't a contract, so for example, you're providing services ex gratia, or where a limitation period applies. That will be because the elements of the cause of action for negligence are slightly different from contract. In contract, you need to prove that there is a contract and the other side breaches. Okay? That's the point in time where the person who has breached becomes liable for a breach of contract. However, in tort, the elements actually occur. The duty and the breach element can be satisfied at the time the advice is given. But the third element, the harm, may come quite a lot later. As such, it's not common, but it's certainly within the realms of possibility that the 6-year limitation period for breaches of contract have been exceeded, but the 6-year period for the equivalent breach in tort is not. So you do need to be aware that those two causes of action are different and distinct, and that the time periods for each may not be in alignment. Finally, note that when you're providing services to consumers, the Australian consumer law is going to apply, and there's a statutory requirement that a provider of services use reasonable care and skill. It also means that the remedies under the Australian consumer law are available, the powerful statutory remedies, and the consumer can go to QCAT as part of that if you're in business.